Good afternoon. It's a privilege to welcome you all to the 33rd Annual Marine Money Week. I do wish we were all together at the pier on this lovely late spring, early summer day. The only thing that could come even close to our tanker panel, which is just ahead, would be dinners and drinks at New York's rooftop bars. We all hope that you're safe and well. And while the physical absence is tiring, as the enthusiastic chronicler of our industry's commercial and financial achievements, I can honestly say that the creativity, pace, and transactional execution you all continue to produce under such challenging times inspires us all. Thank you for that, and for the emails and the calls, all of which mean a great deal to us. I would also like to thank all of the ship owners and managers who have worked so long and tirelessly on behalf of our industry's essential colleagues, our seafarers, who throughout the pandemic ordeal have kept the props turning and the world's logistic pipeline moving. While the nations, each in their own state of pandemic despair, have often deserted the seafarers, I am humbled and proud of all of you out there who have not. And I look forward to the next discussion among three of the most accomplished members of our industry who have supported us literally almost from the start. Thank you. And thank all of you for joining us. I will now turn you over to the producer of Marine Money's webinar series, John Chia. Thank you all.
Hello, everyone, and thank you, Jim. So this is just a quick note on how we'll be handling the Q&A session today, which if you tuned into the previous session, it's a lot similar. For this webinar, the audience, you, will be muted to ensure audio quality control. During this webinar, you'll have the opportunity to ask questions to the panelists. We highly encourage this as it makes the session much more interactive, and it is in fact why we do it as a live session. And it also allows the panelists to engage with you and vice versa. To ask a question, you simply need to enter it into the text box at the bottom of your GoToWebinar control panel, as you can see on screen right now. And the only other thing that you might want to do is collapse the menu, which is that top orange box with the arrow in it. That will collapse it so that you can see Randy's presentation and the speakers in full view. So with that being said, now I'm going to hand it over to Randy to kick the session off.
Awesome. Well, hey, thank you, Jonathan, and thanks to Marine Money for hosting this panel. So today we have two very distinguished CEOs here from Diamond S Shipping, Craig Stevenson, as well as from International Seaways, Lois Zabrocky, and myself, Randy Giveans, Senior Analyst for the Energy Maritime Equity Research Group here at Jefferies. So with that, today's tanker market, just looking at the dynamics of what has been going on, it's certainly been a volatile and wild ride these last few months. So fortunately, we have Craig and Lois to shed some light on that and ideally give us all the answers for what's going to happen in the months ahead. So with that, let's start with the crude tanker market. Jonathan, if you can go to that first slide showing the rates. So obviously rates started the year pretty strong. We were at over 100,000 a day for V's in the beginning of January, 50,000 or so for Suez's. Even the products tanker rates were strong. Market fell pretty dramatically throughout January, throughout February. A lot of that's seasonal. And then in March and April, rates, as we say here in Houston, were on fuego. So the last 6 weeks, rates have fallen dramatically. So obviously you can see the kind of highs and lows of the crude tanker market. We're going to specifically focus on that before we get to the refined products. And fortunately for DSSI and INSW, they operate in both. So we have a good panel here. So with that, I'll kick it to Lois first. Can you give some color on what caused rates to surge, let's call it in mid-March, then again in April, and then obviously to kind of fall apart here in May and into June. Now VLCC rates still holding strong at 50,000+ a day, but as you can see on the chart, the smaller asset classes especially have come in. So with that, enlighten us. What has been happening in the last couple months?
So absolutely, Randy, thank you. It's great to be here. So we saw, with coronavirus, of course, starting in Asia and really having the first impact there, hitting demand and crude oil and product demand first. That really started to slow down. First of all, you had Saudi and Russia produce more oil at the same time as you had the coronavirus hitting. So all of a sudden there was an excess of production in the world. and you saw the oil curve drop into pretty steep contango, very low oil prices today, much higher oil prices forward. And everybody was customers, oil companies looking to store oil onshore and at sea. And across the tanker space, that was very advantageous for us, and we were able to respond to that, and that really took up a lot of demand and made rates spike significantly first really on the crude, and then it eventually went down through the product carrier market until LR2s were extremely strong, as well as LR1s and MRs. And then what we've seen happen is demand has started to come back, production has started to fall, and the market is seeking a balance. And you've seen a lot of the contango come out of the oil curve. Today, I think the contango is about $2. Brent's, prompt month +6 is about $2. So it's really still in contango, but not anything that would encourage storage at sea. So now we're in a much more finely balanced market. And I would say the VLCCs are still holding up, largely because China came back on ahead of the rest of the world, really with a vengeance with their oil demand. And in May, they had higher oil imports, crude oil imports, than they've ever had before. So we're hoping to see a continuation of that return of demand as the rest of the world starts to come back online.
Sure. Good thorough answer there. Thanks. And then same question for the products tankers. And Craig, obviously, if you have anything to add on the crude, feel free to do so as well. But specifically on the products, what kind of caused that rally to record levels, right, in April, and then the subsequent fall, the last, let's call it 6 weeks?
Yeah. I think you see floating storage from time to time in the crude side of the business, which is not that unusual. Just depends on how deep of contango you get into. What's unusual is to see it in a meaningful way in the product side of the business, and especially using small ships to store various types of products, whether it's diesel or it's jet fuel. The airline industry just was completely crushed. And so airline travel basically stopped overnight. And so they ran out of floating storage. And so they're looking for any way to store the oil. And as a result of that, they put it on there, just about everything. And so you have MRs, you even had some handies in floating storage. And so, it's a strong market, but at the same time, it has the flip side of that market, and that is you need to segue from floating storage back to a normal market. And so, I think the good news is it's happening faster than we originally thought. Demand's starting to pick up, and so I think a lot of people thought it would happen much later in the year, but it's actually already started. So.
Sure. And then, Jonathan, if you can stay on this slide for a second and then go back to the previous slide in a couple seconds. But just looking at where rates are today, you see rate levels here, 1 week up pretty strong for the LR2s, softening for the smaller asset classes. Still, 1 year, year over year, let's call it, 80% increase in the LR2s, 13% in the LR1s, relatively flat for the MRs. And then, Jonathan, on the previous slide, you'll see similar moves in VLCCs. They're flat to up, smaller asset classes kind of falling off harder there. So 2 questions around that. First, what kind of level of spot rates are y'all seeing prompt, kind of current? Are those average or fair rates, let's call it, for your VLCCs and Suezmaxes, Lois? And then if you go over to the MRs for Craig and for the Suezmaxes as well for Diamond S, are those rates, low to mid-teens for Suez and maybe under 10 for MRs? Answering that. And then secondly, on that same question, why the big divergence between the kind of larger tonnage, VLCCs, LR2s going up, and smaller tonnage, Suezmaxes, LR1s, MRs going down?
Okay.
So prompt rates and then kind of the divergence.
Okay, Randy. So, if we really look at it and you say, okay, the Vs are really the only market right now that's holding pretty steady there around $50,000 per day, you know, trying to defend that level. And I think that's really because of China pulling, really having come back on very strong, and that being a long haul run. When you look at the Suezmaxes, you know, we have a couple of those, and that market is struggling more. You know, West Africa, you know, Nigeria being part of OPEC Plus, are really trying to meet their quotas. They've said that they're going to try to make up for any overproduction that they had. You know, that's a Suezmax market. And the Mediterranean, you know, we see Libya out with they tried to bring their fields back online, and that did not, they weren't able to hold that steady. They still had a lot of disruption in those fields. And those markets are very Aframax and Suezmax dependent. So I think the V's are holding up better because China's pulling on those long runs. And then those markets that are more for Afras and Suez are a little bit more affected by some of the cutbacks, and then again some of those outages.
Yeah, Randy, I would say on the Suezmax, actually the number is almost identical between Suezmaxes and MRs today, and so they're teenagers. I think MRs are more or less mid teenagers, and Suezmaxes are toward the upper end, still teenage. And so, you know, just as Lois indicated about China's got a lot of congestion right now, and so it's trying to digest all this additional barrels they're bringing into the country. They actually never really slowed down very much, is the truth of the matter. And so they're sort of the bright light in the tanker space today, and everything else is more or less feeling the evidence of trying to release a lot of floating storage. And so you have tonnage coming back to the marketplace at a time where you have more or less weak demand for oil.
Okay, good. Thank you for the color there. Before we turn to OPEC Plus, briefly for FFA, the forward freight agreements, that market seems to have improved a little bit on the sanctions news and kind of the possibilities of further sanctions. Can you all comment, 30 seconds briefly on that in terms of how that may or will or is kind of affecting the FFA markets, the possibility of further sanctions?
You know, I think that there was a good bit of hype as soon as the government, it was about a week ago, they came out and OFAC said they were going to sanction for specific tankers. Then the market, you know, really got excited because there could be another 40 tankers impacted should OFAC decide that all those vessels that called in Venezuela were going to go on the sanctions list. But what we've seen so far in actuality is certain charterers such as Petrobras decide that they won't charter any vessels that have traded in Venezuela. So we see specific routes where that you know is in actuality happening. And I think some of the steam came out of the paper trading while everybody waits and watches to see how it's going to actually work out.
Yeah, I think it's trust but verify, and so I think it's right now it's a rumor, and until it happens, will it be capitalized upon? And I think getting ahead of, I think early mover advantage in this one could have a lot of risk.
That's fair. Okay, John, if you can go forward a couple slides. So yeah, let's talk about OPEC Plus, right? How have these kind of production decisions impacted the tanker markets in recent months, and what do you think happens in the months ahead, right? Just recently, I guess about a week ago, a little over a week ago, they extended that agreement, the 9.7 million barrels a day, by 1 month, delaying that phase out that was expected in July, now happening in August. So how is that affecting the kind of tanker markets?
You go ahead, Craig.
Yeah, I mean, I think it's a price issue, and so I think the tight oil out of the United States quickly responded and shut in production very quickly, faster than a lot of people anticipated. And so it sort of to the extent that the price actually would go up, into the mid 40s, I think you'd see a tremendous amount of shale come onto the market very fast. And that's probably not in the interest of OPEC plus. And so they're probably going to monitor that price level into the low 40s. To the extent that it gets much more than that, I think you're going to have people cheat. And so the history of OPEC has been compliance. And only recently did they more or less have real compliance to the extent that that country by country needs money. They will produce in excess of what their quota is, and so that's what I sort of see the marketplace. But I think they're going to end up overshooting. They'll cut back on production in a meaningful way. I don't think there's any way that the decline curve of the world can quite frankly keep up. Shale oil can keep up with that, and so when you shut in long dated projects, ultimately it's going to produce less oil, and so the decline curve of the world is what will ultimately win that battle.
No, that's I don't disagree with you, Craig. I mean, one thing, it seems that June is the month where OPEC Plus has decided they will take that extra 1.2 million barrels a day off the market. So from everything I'm reading, it seems that June is the month where things balance out. And then, as you're saying, Craig, you tip into a inventory drawing situation quite quickly.
Yeah.
Great. All right, next slide. Looking at the U.S. exports, that's obviously been a massive driver of the tanker market in recent years. Once the crude ban was lifted in December of 2015, you started to see maybe 500,000 barrels a day in 2016, 1 million barrels in 17, 2 million in 18, 3 million in 19. We hit 4.4 million barrels a day just a couple of weeks ago, or I guess a couple months ago now. So currently we're down to 2.4 million barrels a day. And I know Lois, INSW, has that lightering business, so maybe you can kind of start on this. But where do you see this going in the next few months, ideally into 2021, in terms of U.S. exports? Obviously, production has turned over. Exports have come in as well. But there's still a lot of pipelines ramping up, a lot of export facilities being constructed. Asia probably likes our light sweet barrels as well. So what happens with U.S. exports, both on the crude side and product side, even in this environment and looking ahead?
So exports had held up really strongly. That the latest number was 2.4. I think that was last week. Prior to that, the exports had held over 3 million barrels a day. So it really has held up quite well when you consider how much the shale production has come down. And from what I'm reading, it all depends, of course, upon Trump and what the current policies are. But I'm reading that it looks like Asia may start pulling a good bit more oil out of the Gulf. So to the tune of where it could be 500,000 to 600,000 barrels a day, which would be, really good for the big ships and really good for ton miles, because that trip on a round is well over 100 days, often running with lightering up to 120 days. So that would be very good, and I like to see the U.S. Gulf defend its exports.
Yep, that's fair. All right, you want to go to the next slide, looking at floating storage. I think this is the big slide, the big question. And you have bears saying, oh, destocking is going to take a while, and there's going to be no more imports needed, and rates are going to 5,000 a day. I disagree, but with that, the contango, as you mentioned, Lois, has certainly tightened. The 6-month spread's around $2, right? That said, floating storage, as you can see on this chart, has continued to ramp. Most of that is due to the cargoes that were fixed for floating storage in, let's call it April, even May, are just now starting to load. So all that being said, when do you expect the inventory destocking to really start occur? What does that process look like? And where do you think rates go, right, in the coming quarters? So Craig, I'll let you start on that one.
Gosh, that's a tough one. It's sort of how quickly does demand start to pick up, and how quickly does floating storage come off? And if they mesh up really nice, it could be a relatively modest event, right? but you would see it sometime in the end of the third quarter that it probably more or less manifests. And I think that's a tough one to predict, and that is, tell me all the various time charter rates, how long they are for. A lot of them are shorter term than you think, and quite frankly, it is the most expensive storage they have. And so, the real issue is the demand side of, it's flying, it's the economy of the United States, it's driving. Driving plays a big role in the demand curve, and quite frankly, refinery margins are dreadful today. Talk to anybody in the refining business, and so all those things I think make for a sort of an exciting third and early fourth quarter event. Now the fourth quarter is typically one of the better quarters that you have of the year, and so you should have some pickup in demand at that time of year. But I would say that the process has started earlier than we had thought, and I think demand is starting to pick up. So it could be a shorter sort of segue from a unusual market to a normal market, and I think that's what we're all sort of hoping it is.
Lois, anything to add there?
Well, I would just say it seems, knock on wood, that the absolute low in oil demand was April. The EIA had, May coming back on by about 4 million barrels a day. And I'm assuming with all of the opening that we've had and the amount of increase that we've had in the US in demand resurgence, we start to climb our way back up to levels, that we, had seen before the coronavirus, right? So absolutely demand at the end of the day is what we look for. And, all of these reductions, roughly 10 million barrels a day from OPEC plus, that really impacts the amount of cargoes being moved. So I would look, in the third quarter for some barrels to come out of storage. And that is traditionally the weakest quarter of the year. And I would think that we would start to see that happen. But you still have a contango market, even if it's not dramatic. And that still lends yourself to a little bit of balance at the moment.
Yeah, I know, Lois, I think there are a couple of ships that actually went into floating storage just recently. And so I think people are renegotiating those numbers. At the end of the day, it's a market by market driven event. And so, you might be surprised. You might have floating storage last longer than we think. You just don't know.
Yeah. And then what about your two companies specifically? Any vessels currently sitting idle, anchored with a cargo on board for a floating storage contract?
Yes. We have a couple.
Okay. Lois?
It's unfortunate that we didn't have more than a couple, but
that's right.
Sure. Hindsight
That's right.
2020.
We didn't like that a couple of months ago. We wanted them all discharged and fixed at high levels, and now we like them on storage.
Feast or famine.
That's correct. We're hard to please. On the Seaways side, we did have 4 VLCCs that were taken for storage contracts, but also with the ability to trade. And those vessels are on their way to loading cargoes. So we're going to see once they get loaded up, when they sit. So if we don't even know for our own fleet how long those, they will sit, or will they start trading, I think that there's an element of question over all those Vs that were taken for storage. So it's definitely a challenge. And then we are seeing vessels where they're having a slower turnaround in Asia right now than you normally would. And we're quite fine with that, because that's really absorbing some tonnage.
Yeah,
sure. And then outside of just floating storage, how has the kind of time charter market, rates, liquidity, how has that developed here in the past 6 to 8 weeks as spot rates have come in?
Recently, it's certainly come down, and so you've taken a lot of the, I think most of the floating storage deals were probably more like, 6 months. If you were a little ship, it was less than 6 months. If you were a Suezmax or bigger, you might get lucky and get 6 months to a year. A handful of people got a year. We didn't. We had one on subs. We thought it was gonna lift, but it didn't. I think on the product side, I mean, you could have as short as 30 days, and so you could have some very short-term related floating storage.
Okay.
And a lot of the commodities on the smaller ships, and whether it's jet fuel or it's diesel, you actually have to turn the material relatively quickly. Jet fuel picks up water. Diesel, basically, after about 6 months, it can actually have some problems as well and need to be reprocessed. So there's some practical aspects to the floating storage. On the crude side, it's not really the case.
Sure. All right, Jonathan, we go to the next slide. Just switching over to fleet supply, right? There's a lot going on this slide, so I'll give you some time to kind of digest it. But basically, there's two charts here. One is showing kind of the historical supply picture in terms of orders, deliveries, scrapping, and the other kind of on the left showing where we are currently in terms of the order book to fleet percentage, the lowest in, 20 years, and then the average crude tanker age, arguably the highest in 20 years. So with that, there was basically record scrapping, as you can see there on the bottom right chart in 2018. Not much in 2019. Again, not much this year, obviously with the very strong rate environment, with the very weak bunker fuel prices. That said, there are a lot of vessels over 20 years of age throughout all the asset classes. So given where rates are today, given the outlook for the back half of the year, 2021, do you expect much scrapping as a response here in the coming quarters?
I would definitely say that as we start destocking and you've got the ships coming out of floating storage and rates do come under pressure for a period, we will see vessels leave the fleet. One of the latest things that's happening with classification societies is that if you take, for example, the yards have been very busy and also haven't had a lot of labor. So if you need to extend your vessel's dry docking, that will now be considered a condition of class. And I think that as those regulatory pressures come in line and rates come under pressure for a period, the 200Vs, say, that are over 15 years old will start to come under pressure. Some of those to leave the fleet.
I hope so, Lois. Usually, it takes a little. It takes a while of bad rates, and so the question is, how long will the bad rates have to persist before you scrap tonnage? I'll tell you, if you had a normal market today, the order book the way it is, people would be ordering ships, I think, and so we certainly don't have a normal market. And we have a near-term, difficult to predict market. It's super difficult. I mean, you can take the smartest people in the world, and they can't really, with great certainty, predict what the market's going to do. And so, clearly, once you turn 15, the way the system works, it just puts immense pressure, both from the customers that you charter your ships to the cost that you have to incur to operate ships effectively. It just puts a lot of pressure for you to move the ship. And so the age of the fleet continues to get older and older, and so it just accentuates the ultimate issue of scrapping your ship. And so the question is when, right?
Sure. So yeah, staying on this slide, and one more kind of market question before we get to your company specifically, but how do you view the kind of current order book today, as you can see there on the bottom left side of that chart? Do you expect this to grow materially in the coming quarters? Why or why not? Is it access to capital? Is it shipyard capacity with all these LNG orders, flooding the berths? Is it uncertainty around environmental regulations and IMO 2030 and beyond? So what are your thoughts on the order book now and where it goes here in the next few quarters or years?
You know, all of the above, Randy, you know, all the reasons you're listing is really right why you have single digit amongst most sectors on the tanker side. I don't think that we should ever say, oh, it's yard capacity, because I don't believe that at all. Although I do like very much to see the Qataris come in and take a lot of these high value berths and give the yards some, you know, comfort that they're going to have high value orders of vessels to build. So that's a positive. You know, when dry cargo is starting to pick up, that's a positive. You know, it's when some of the markets around us are healthy and start taking up some of that yard space, that's a positive for us on the tanker side. But from the perspective of, you know, what type of vessel to build, do you want dual fuel? You know, what is the pricing going to be? Are you going to have inflationary pressure? All of those things, I think, come into play. And the order book will increase, but I don't really see any particular stimuli for it to really grow substantially. So I'm thinking if we can hold it at single digits, that's really powerful for the tanker sector in general.
Yeah, I basically agree with everything Lois has just said. You know, it's a difficult decision right now in this environment to think about ordering a lot of ships. It's just tough, and so you don't know what 2030 means. There's no sort of automatic winner. You know, if you put this type of engine or you go dual fuel, there's no easy answer to that question right now. And I always look to the amount of capital that's in the industry. I don't think the industry is flush with capital today. Capital markets are more or less not open. And so you ask yourself, where does the money come from? Now, money always finds its way into our business. And the second we think we don't have enough money in the industry, you know, somebody comes in out of the blue. But by and large, I think you're going to have the odd order that comes in that is sponsored by some country or some large organization. But I don't think you're going to have the industry as a whole order a lot of ships not quickly. So
sure. No, agreed, Craig.
All right. Well, I know we spent about 30 minutes there or so on the market, so let's spend about 10 or 15 on your companies. So Jonathan, next slide. So how do you balance kind of spot exposure and time charter coverage in this market? It's volatile. It's uncertain. Yeah. Obviously, like you said, you wish you had a lot more time charters booked a month or two ago, but we can't go back in time. So as of today, how do you like your positioning in terms of spot versus time charters?
Is that to me first, or?
Sure, Craig, go for it.
Yeah, and so we were 80-20. 80% spot, 20 time charter, and now we're 70-30. As I think I indicated earlier, I think we would have loved to have done a little bit more. I think we still believe in the spot market. We like the long-term dynamics. So it's been an incredibly long period of time since we've seen the order book this low, and I think we're going to get through this current crisis that we're under, and on the other side of that, it looks incredibly fantastic for a good tanker market. And so I think more or less we're happy with that 70-30 split today.
Okay, Lois?
Yeah, absolutely. So we've got 10 ships. 8 of those are on 6-month charters. So you've got the 6 Panamaxes that are on 6-month charters, and then 2 Vs on 7-month charters. And then we did 1 year at 53 and then a 3-year at 45 on the Vs. So, but what I would say, there was a window, and it wasn't just it was your vessel had to be prompt and ready to go for those potential storage contracts with a window of like May maybe early June, something like that. There's a particular set of dates that was very desirable. Your ship had to be in the right spot in order for you to get those levels that we found attractive for time charter. So, there are still time charters being done today, but those are being done, as Craig mentioned earlier, at lower levels, short periods. And so, when you get to a certain point, it's better to stay spot and take advantage of the fact that look at all the volatility that has been in our market and how many times we've been, surprised to the upside in this market. So you don't want to lock in something that's really low for too long a period, because you're going to miss those good market fundamentals when it comes back and reasserts itself.
Yeah, I think those 6-month deals, it was all about that first voyage out of the box. And if they could get a $100,000 a day voyage, they'd put you on subs for $50,000, $55,000. And so it was all about that first voyage. So
yeah. Good. Well, thanks for that, Craig. Be careful with that bullish commentary. You might lose your.
I know it's not my style.
You're the bear. You're the bear. Come on, that's okay. We'll take it. So yeah, after a solid fourth quarter, 2019, both of you had kind of record results, right? In the first quarter, second quarter is also shaping up to be another very strong quarter, if not record. With that, you have some options, right? What are you going to do with the free cash coming your way? So let's look at each of these three options here. First, in terms of balance sheet deleveraging, debt prepayments maybe. Your balance sheet's already pretty strong, arguably under-levered at this point. So what is your target or maybe ideal leverage ratio or net debt to cap, or do you even have one? And then secondly, with the uncertainty in the market, are debt repayments like the first and primary focus at this point? Lois, we'll start with you.
Okay, thank you very much. I appreciate that. As we had publicly announced, we executed a $10 million of a $30 million buyback program, in the first quarter. And we talked about the fact that we feel that our shares are trading below what we think, really where they should be, and that they represent excellent value. So I think from a capital allocation perspective, we've been pretty forward with saying where we think that is. What I would also say is in the first quarter, when we executed our refinancing, we also delevered our balance sheet, and we instituted albeit just over 1% then at 6 cents a quarter, but something that's long-term sustainable. And we actually in the first quarter bought an LR1 that fits into our Panamax fleet. So we executed across the board on capital allocation in Q1. But we've been pretty vocal on, asserting that we think our shares are trading below and at a very good value.
Perfect. Craig, over to you.
Yeah, so we have a large revolver, and so we are slightly more levered than we'd like to be. And so in a sort of a perfect world, about 40% is where we'd like to be. We're a little bit above that. Okay. We've paid down some of that revolver recently. But clearly, by far and away, the best thing that we can do with any excess cash today is to buy back our shares. We're just like Lois. It is incredibly cheap. And so the only thing that inhibits you from buying back more shares today, and we do have some restrictions with loan agreements, but we can still buy back more shares, is quite frankly the near-term outcome of what we see in the marketplace and getting through the excess storage, quite frankly. And as we get closer and closer to that event, I think I'm trying to give you a signal that we're encouraged by the unwind starting sooner than we thought, and the improvement in demand. It's not what it needs to be, but it certainly started sooner than we thought. A lot of people are thinking about driving on vacation rather than flying on vacation today. And so I still think the most attractive thing you can do is, when you have your share price at roughly 50 cents on the dollar, it's incredibly attractive from a shareholder perspective.
Yeah, absolutely. Accretive to NAV and all these other things. So,
Yep, everything.
Yep. Good to hear that. Briefly, these last two bullets here, IMO 2020 compliance. You know, I know both of you have some scrubbers. So if you can just give us a quick update on how many you've ordered, how many are installed, how many are yet to be installed, and then what kind of savings you're seeing. You know, obviously with the fuel spreads coming in pretty tight, you know, maybe $60 a ton between VLSFO and HSFO, with diesel prices so weak, with Brent prices so weak.
Yeah.
There's still savings there, right? So if you can quantify that, and then kind of give us an update on the timing and this kind of scale of your scrubbers. So Lois?
No, absolutely. Thanks, Randy. We've installed 7 of 10 scrubbers on our modern VLCC. And, you know, we installed them. Some of those were not eco vessels. So you're really seeing the most savings on those vessels that are non-eco, but have a long life ahead of them. So, you know, we're looking at somewhere around $5,000 per day in a savings. We think that would increase when oil prices rise, and if you see differentials widen again, which is what we think will happen. The other 3 we intend to install next year, coordinated with the last 3 vessels' actual normal dry docks. And we're going to play that by ear and see how the differentials are actually manifesting themselves.
Thanks. Craig?
Yeah, so we originally installed it on our 2 time charters to BP, you know, 2 Suezmaxes on to BP. And then we had 3 more vessels that we had committed to as part of the transaction with Capital. And so one of those has just recently installed a scrubber, but the other 2 are scheduled to install scrubbers, and we've yet to make that decision.
Got it. Okay.
I mean, the delta is not particularly exciting relative to the expenditure.
Yeah, I would think on a Suezmax now it's 1,500, 2,000 a day, maybe.
Maybe, yeah.
Fair. All right, last one here, vessel sales purchases. You know, Lois, I know INSW has arguably the most diversified fleet with some modern vessels, but you also have some older vessels in the fleet. Same thing to Craig, you know, you have some older tonnage across your MRs, you have some Suezmaxes there. So I guess Lois, starting with you, you know, how do you look at your current fleet in terms of sales candidates or maybe acquisition candidates? If so, which kind of asset class, and would you look more at resales, new buildings, second hands? And then I'll turn it over, kind of the same question to you, Craig, after Lois.
Yeah, so we've been, you know, quite vocal around doing secondhand vessels since our inception, so almost 4 years. That does not mean that at some point new buildings won't have a place in our fleet, but right now we've been very focused on everything being secondhand that we've purchased to date. And, you know, when you're looking at it, I think we've sold 20 secondhand vessels over the last 3-4 years. So we've been steadily upgrading the fleet as we go. We're a little bit, from a capital allocation perspective at this moment, more focused, like I said earlier, on you know, when you're trading significantly below what you perceive to be the value of the company, on you know, repurchasing shares. That would be a higher focus for us at this moment than bringing in more vessels. But we want to be able to be ready to do that when the cycle, it's the right time.
Okay. Correct.
Yeah, and so I guess I would look at it as capital allocation today. And so what's the most attractive thing you can do with your excess cash today? And it's clearly to the extent that you have meaningful amount of excess cash, your shares would be the best place to put it. You know, we do have an age profile on our product side of the business, and we're certainly continuing to look at that. It's actually been sort of you know, an exceedingly difficult S&P market. So very few people would have been able to execute sales of vessels recently. I will say that, you know, there is some slight pickup in interest in that regard, but we are certainly monitoring that given the age profile of our product fleet.
Sure. So it sounds like either way, there's no large scale new build plans, you know, kind of look me in the eyes and tell me there will be no large scale new build.
That's great. Okay.
I like that. Yeah, that's right. That's right.
All right. Good deal. And I guess last question on that same thing, we get the question, hey, these tanker companies, they're trading at a 30, 40, 50% discount to NAV. Why not sell 2, 3, 4 vessels, use the proceeds, pay off the debt on the vessels, and the remaining 50% of proceeds or whatever you have left for share repurchases? You like that idea, Craig?
Well, I mean, I think that makes a tremendous amount of sense.
Yeah.
Earlier in the year, I mean, try to sell a ship without getting an inspector on board your ship.
Sure.
Pretty hard to do, right?
Yeah.
You can't get crew. You can't get your crew off, and you can't get their crew off.
Yeah,
so it is truly inhibiting the number of sales out there that can really.
No question about it. No question about it.
Cool. Well, I think I'm getting the old hook from John. So with that, I'm sure there's some Q&A that are probably better questions than I posed. So John, if you have any questions from the audience or others.
Yeah, no, that's great. Thank you all for taking us through that very comprehensive market outlook. And Randy, feel free, I mean, you don't usually need an invitation, but feel free to also jump in on some of these answers that I asked both Lois and Craig. So I think the first one is that some shipping CEOs and analysts have expressed that we are in the midst of a super cycle. What are your thoughts as to whether the industry is in or in the beginnings of a super cycle, which would entail outsized financial performance for tanker companies?
Gosh, Lois, I know you want me to go first.
Yeah, Craig, you take it away.
Go for it.
I don't know what to say about a super cycle. I mean, we certainly had a super cycle from 2000 to 2009 or whatever it was, and it was largely off the back of global growth, and China was leading the charge on that. The order book is something that is certainly indicative of a super cycle. There's no question about it. But there are other issues as well that sort of play into that. I think if we had a robust world economy, I would probably agree with you. It could very well be a super cycle. If you look at the amount of debt that's in the world and the interest to keep interest rates super low for a long period of time, makes for a very unusual investing environment. And so I'm not sure I buy onto the super cycle just yet. I know that Randy wants me to be bearish, and so I'll sort of have the conservative Southerner view of this.
Yeah, what I would say, I haven't really heard people in this cycle saying it's a super cycle, whatever exactly that definition is. But I would say that we're in a very volatile place. And when tankers are in a volatile situation, there's a lot of potential for upside. And I do think that we're more balanced. The coronavirus is something that we all have to navigate. This is not anything that the modern world has ever seen, where we've seen demand impacted the way it has been, and the way that the oil production has had to respond to that. So I think we do have really good fundamentals, but we also have to really be vigilant and watchful of our market, and really watch that volatility.
Great.
And I'll just briefly mention, I've never used the term super cycle in this market, but it's all relative too, right? When you look at rates from 2017 and 18, 19 was pretty good. 20 is going to be good regardless of the next few months. And then, right, the seeds are sown for a very strong market in 2021, 2022. Tons of variables. I'm not even going to try to guess rates for 2022, right? Because of the new build ordering, because of the economy and COVID and all these other things. But the table is set, I'll just say that, for a very strong market in the next few years.
Right.
Fantastic.
I agree with that.
So another question that came in is, so with refinery margins so low, high offshore, onshore inventories, and demand pulling first barrels from storage, what will trigger freights for product tankers like LR1s and MRs to start to pick up again?
Probably driving.
Yeah.
Driving and the return of the airline industry. Those two things are as important as anything, right? And so if you sort out somehow, some way, a solution to the virus, people will fly again. So it's a question of when do they do that.
Yeah, and I think, Craig, just to build on that, you're seeing a little bit of life in the LR2 market. Some of that is naphtha. Naphtha has been a little bit more competitive than LPG, and you see a bit of a pull on that. So some of these different product streams where you see demand coming back on, that gives us a little bit of life and stimulates some of those margins in certain sectors.
Yeah.
Okay, great. A question about investors. Do you feel like the investors understand your business? Has the investor profile changed recently?
I'll go first on that, Craig. I think that you saw a lot of a steep increase in liquidity in amount of shares traded during the storage. There was a huge amount of retail interest. And we were just discussing it today. You've got retail interest that's very short-lived, but then you also have retail interest that are more longs and are more interested in the industry fundamentals. So it's a little bit of a mix. I think there was a tremendous amount of short-term interest that came in and went out of our shares very quickly, but there is still a reasonable retail component that are long onlys to some degree in shipping.
Yeah, we sort of started off with what I call fast money. They came in and quick buck, but now it's like sector rotation. It's rotation out of growth into value, and when you're playing with 50-cent dollars, there's a lot of value here, and so the real question is sort of what the rest of the year looks like. And so as soon as we can sort of put a little bit more light on what the rest of the year looks like, I think you're in good position.
Yeah, and I'll say briefly, March and April, the only question people are asking is, what are rates today? What's the floating storage contango? What are the economics? How profitable is it? That's all people cared about today. Now, over the last 6 weeks, it's, hey, what do rates look like in a quarter, in the end of the year, 2021. So I think people are starting to see a little further, looking further ahead. But the breadth of investors has certainly expanded, right? I'm talking to investors I've never spoken to before in the last couple months. Energy investors, small cap investors, value investors, income investors, now with these big dividends, especially from some of the tankers and others. So it's certainly kind of widening, and now you're starting to see a little less kind of myopic focus on intraday Brent moves and the spreads and for floating storage contango, and now people are looking more at supply-demand fundamentals, which is probably a healthier way than just kind of day trading rates.
Agreed.
All right, that's fantastic. For the VLCCs that are fixed and can start trading at any time, how are your teams making sure they'll perform to charterers' expectations, especially after being idle for longer than usual?
I think most ship owners, and certainly at Seaways today, we work with software that's been on board the vessels for a few years now, and we're constantly monitoring the efficiency of the vessels. Do we need to do a bottom clean? What can we do to tweak the vessel's performance? And we're looking at across sister class vessels, what is optimal performance? So I don't really feel like that's a big issue. I feel like ship owners today are really on improving, monitoring the vessel's efficiency and making sure that the ships are performing up to the charter's expectations.
Yeah, I mean, I think Lois is right. I think it goes into the calculation, quite frankly, of going into floating storage in the first place, right? And so you're thinking about a ship that needs to go to the yard, 6-9 months from now, And so you know there's a good chance you'll foul your bottom, and to the extent that you go into the yard pretty quickly after that, you're no worse off in a sense. But it's highly likely that if you have any appreciable period in warm water, you're going to foul your bottom. And so what you'd rather not do is take a ship that just came out of the yard and put it into floating storage. And so there's some practical, cost-saving ways to address that.
Okay, that's great. And we have a couple of questions that are coming in around, vessel ordering and vessel sales. So I'm going to try and not have them overlap, but so bear with me on this one. So if you decided to, follow up on vessel sales, if you decided to divest some ships, especially if trying to repurchase shares like Randy suggested, which classes / types / ages would be the best sales candidates, and which types would be best to keep?
Well, maybe I'll jump in there, Craig, because we have so many types. Yeah, we've definitely, we look across the fleet at exactly what Craig was just talking about, which vessels are coming up on a dock, which vessels are perhaps your least efficient units. And we've sold everything from, handy tankers, MRs, AFRAs, everything that we've sold has been more than 15 years old. So those are the vessels that you're going to look to harvest from first. And you're going to look at each individual specific ship across that fleet.
Yeah. We tend to look at it on a value, an age-adjusted value, and to the extent that and I know you do it as well, Lois, but I mean, to the extent that it's at a very, very high number relative to its age, historically, I wouldn't say it would be limited to class. It would be any type of ship, quite frankly. I mean, we're in shipping, and so just about everything is for sale.
That's right. You're just like, I think what you're saying, Craig, we look at that discounted cash flow across the fleet all the time. Yeah. And, you're going to look for, combine that with the practicalities of who's coming up on a dock, and then you're going to prune where you can.
Yeah.
Okay. And to kind of follow on that is, this kind of, the development of the order book. Do you consider a risk that a portion of the huge government stimulus programs could take the form of massive orders in local yards to support local employment and economies?
No.
Nice and clean.
Craig, I was going to say yes.
I don't think, not local yards. So we're going to Newport News, are we?
No. Korea, but in Korea, Japan, China, but we always worry about that. That's really, I don't think that really has particularly changed, where, you're always a bit concerned that in some of the yards, the amount of people that are working in those yards is really something that's part of the national employment program. So that's always a concern, but I think that we haven't seen any real moves for that even in the Far East at this point.
Yeah. Okay. We have a couple of questions kind of around IMO 2020 and beyond. So how is the IMO 2030 compliance and energy efficiency going to impact the value of existing assets? New designs compared to the small delta we see with IMO 2020 compliance. And what happens if this kicks in already 2023 with grandfather clauses as been indicated by the IMO?
Okay. You want to start, Craig, or you want me to?
It doesn't matter. I mean, I think most of the compliance has some element of going much slower, and so that tightens the market. I don't think that there's any particular, for instance, going to all the various different types of engines. There's no winner today. And so, you even see ships being ordered recently that have conventional engines. And so I don't think there's any recognized way to go or way not to go. I'd tell you dual fuel today is a pretty expensive option, and you're not going to realize a return on that additional expense for dual fuel in the current market. So I think most people are sort of waiting and watching. I think it has retarded ordering activity, quite frankly. What are you laughing about, Lois?
Fair. All right, well, that makes sense. I mean, I have one more, so we have two questions before we're going to have to close this down. But, the second to last would be, some business entities have been formed to finance energy efficient improvements for ships with sharing of result savings. Would this be something that ship owners would consider to reduce risk of adopting future compliance technologies?
Just repeat that, Jonathan. Are you saying, like the publication of our EEDIs and basically our consumption? Because that's something that all of us are, doing and either are doing or will be doing. And, you're looking at your baseline of where you start and then increasing your efficiency from there. So I'm not sure if I'm answering the question, but can you just repeat that?
Yeah, no, let me go over this again because it is a little bit vague. So some business entities have been formed to finance energy efficiency improvements for ships with sharing of result savings. Would this be something that ship owners would consider to reduce risk of adopting future compliance technologies?
And I would say, yes. And, regardless of whether, you're not going to take every vessel in the world today and scrap it and buy a brand new ship. And I would suggest that's really probably not very eco. So I think the focus for people like, us at Seaways is, again, looking at the baseline of your ship and where it started from, and then increasing that ship's efficiency as we go along on our trend line.
Okay. And so this last question is, for all three of you. As the rates decline, do you expect some louder noises in the market about mergers and consolidation? Craig, let's start with you.
Yeah, I don't know that you need that. Quite frankly, I think you've needed consolidation for a long time, and I would certainly hope that you would get it. It's a horribly fragmented marketplace that companies that are like-minded need to come together, and so I'm a big believer in that. I think merging on a typical merger, results in the balance sheets coming together. A lot of people do the same thing by doing pools, and so you get a lot of the effect of a merger in a very inexpensive way. And so I think it should be, and that is, I hope the industry continues to consolidate. It'll be for the benefit of everyone.
Craig, we're definitely big believers in pools, as you mentioned, so I just build on that. But I do think that, from an investor perspective, it does seem that scale matters to, if you're over $1 billion, you get up there to $2 billion of, rarefied companies, you're going to get a higher amount of your shares traded, your liquidity, and interest from investors. So I think some of that will continue to spotlight, all of our sectors in shipping to kind of take advantage of that. Perhaps we have too many listed companies that are not big enough to really get the investor interest that we like.
Market cap is important. So.
Sure. And the pools certainly provide a operational advantage as a merger would, but mergers are kind of required to get that financial kind of leverage and synergies and scale. Market cap for sure, access to debt financing at the banks. They're a lot more likely to lend to a ship owner with $2 billion of assets as opposed to 200 million, right? And the same certainly on the market cap side and the trading liquidity side. The larger companies, I talk to some bigger clients often, and I pitch some smaller companies, and they say, hey, we really like the story, we really like the valuation, we just can't really make a move in that without moving the needle aggressively, or we could never get out of that, right?
Yep.
So there's certainly reasons for consolidation. I'd say there's multiple. So you would hope that there would be more of it soon, as Craig alluded to and as Lois alluded to. So we'll see how the market unfolds. But you do want the capital markets to improve. You want kind of more certainty, less volatility. You need the shares probably get closer to NAV. So we think there
That
can
would help.
there can and will be probably further consolidation, but we won't maybe not see it this month, but hopefully by the end of the year 2021.
That's great. Well, thank you very much, Craig, Lois, and Randy, for having a really engaging talk. I really appreciate you guys going through the entire market and then kind of doing the Q&A session at the end. Thank you to the audience for throwing in a ton of great questions for the panel. This webinar will be posted on our site later today or tomorrow, so keep an eye out for that. And don't forget to tune into tomorrow's webinar, which is on the dry bulk market. But for now, this is Marine Money signing off and thanking you all.
Thank you.
Thanks again for the opportunity.
Take care.